So Liberation Day has come and passed, and virtually every trade partner with the United States faces at least a 10% tariff on all goods. For many countries, that number is much higher than 10%, like China. It's now up to 54% because of tariffs earlier this year. The European Union, made up of 27 countries, at 20%. Vietnam, 46%. Japan, 24%. The list goes on. Wall Street, not feeling so great about this. Stocks plunged today. The market combined really haven't had a worse day since June of 2020 in the midst of the pandemic. But President Trump says this is just a temporary setback, and his administration is playing the long game.
We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers. And ultimately, more production at home will mean stronger competition and lower prices for consumers.
Now, many economists say lower prices or more jobs. Those things are possible, but in the long run, it could take a while. Again, this is a long game, but in the meantime, it can be a painful game to play because they say prices will likely go up.
We're not talking about weeks or months, we're talking about years. So in that interim time, a lot of people will be facing much higher prices.
All right, so here to help us sort all this out, hopefully you've recognized him now because you've been on here at 7 o'clock a few times. At least figure this out the best we can. This is Scott Lincicome. He's the Vice President of General Economics at the Cato Institute, also a lecturer at Duke University Law School. Great to have you with us here again tonight. So based on what you've seen so far, what do these tariffs mean, both in the short term, as we talk about that, and the long-term play?
So in the short term, like you said, higher prices are all but inevitable. There's only so much in terms of profit margins and domestic availability that allows for the prices at our stores not to go up. So inevitably, you're going to see some amount of price increase, particularly on things like, say, avocados or other things that we just don't make here in the United States. Beyond that, I think you have to be concerned about American manufacturers. You know, about half of everything we import in the United States is stuff used by American manufacturers to make other stuff. And at least in the near term, that with new global tariffs, that means higher costs for manufacturers. So either they pass those costs on to consumers or they eat those costs. And that means less hiring, investment, and output. So that near-term hit's going to be pretty serious.
You know, the tariffs, for a lot of people, this is the first time they've heard of them. It's the first time they're really diving into them. They're really not new. I mean, Canada and the EU are really tough on the U.S. dairy industry. There are plenty of them. I don't want to get into the list that was showcased today or the accuracy of it, but we know that tariffs kind of go both ways. And if they're so horrible, if they're so bad, why is anyone tariffing anyone?
Right. So the first thing you have to know is that for developed countries like Canada, Europe, and the United States, generally average tariff rates are very low. You're talking about 2% on average. But every country, including the United States, has politically sensitive industries, dairy, pickup trucks here in the U.S., certain things in Europe, that those are going to get higher tariffs, or they're economically sensitive for security reasons. But those things are certainly worth negotiating over. They're certainly worth the United States complaining about. But in general, these broad-based tariffs to respond to what are really narrow tariff peaks aren't really the best way to do it.
Let's talk about the trade deficit, because that sits kind of at the center of this entire conversation, and it's pretty big. So there's a chart here that shows the largest trade deficits worldwide. If we can, do we have that? Can we pull that up? Well, here we go. So look, that's the United States on the left. Do you notice anything about it? $1.1 trillion. You could stack up all the other countries on this chart, and they still wouldn't be as high as ours. You know, is that a problem that's worth addressing? Because, you know, if the United States is so reliant on imports from other countries, doesn't that put us in a bit of a vulnerable spot? Let's say something catastrophic were to happen on the global stage and we lack the ability to manufacture some essentials. Right. Is that a problem? And is it worth addressing even in maybe an aggressive or extreme way?
Right. So most economists would say that the trade deficit itself is not definitely a problem. It can be a sign, a symptom of underlying problems. but itself is not something that should be fixed by policymakers. But the second big thing is that we have to think about what are we getting for that trade deficit, because we're getting stuff. And in fact, the United States is the second largest manufacturing nation on the planet. During COVID, supply chains were hit, but we adapted quickly because we had this industrial capacity. And that is actually a testament to having an open economy that's flexible and can adjust. The reason we have a big trade deficit is because we invest more than we save. So this is going to inevitably lead to a trade deficit. But as long as those underlying factors, the amount we're producing, the quality of our economy, the size of our economic output, our GDP, as long as those are good, as long as the economy is open and flexible, then we really shouldn't be obsessed with the trade deficit.
We have used aggressive trade tactics or tariffs in the past. For instance, the Bush steel tariffs in the early 2000s didn't really work out that great. The Reagan tariffs in the 1980s kind of had some mixed results. But I want to focus on one specifically, the Smoot-Hawley tariffs in 1930. Of the 1930s, President Trump brings these up a lot. This was right at the start of the Great Depression, raising tariffs on more than 20,000 imported goods. Other countries then responded with some tariffs of their own, and the U.S. exports fell off a cliff. The Depression got worse for a lot of reasons, but that was one of the contributing factors. In 1934, though, the U.S. made some new trade deals that set the tone for decades of trade policy. So here we are 100 years later. Yeah. And we're looking at this scenario. Of course, nobody wants a Great Depression. Nobody wants to even suffer through a recession at this point. But could this be something that sets the stage for a new era of trade that works better for us?
Well, you mentioned Smoot-Hawley. We now have tariff rates after yesterday's announcement that will be higher than the Smoot-Hawley era. And the potential for retaliation and the indirect economic effects are really big. And I think, one of the reasons the stock market was so rattled today is because of those potential indirect economic effects. The question mark is whether this can get us to a better place in the long term. I mean, that's a really big and I think uncertain question. And the reason is because of uncertainty. The fact is that unlike Smoot-Hawley, these tariffs were flipped on like a light switch in the Oval Office. And that means they can be turned off just as easily. Well, investors don't invest based on that kind of uncertainty. You throw in the potential what foreign governments are going to do, the potential for potential trade deals that President Trump talks about he wants to make. And it's just really not an environment that's ripe for this big onshoring move and a stronger domestic investment environment. And that's what really, I think, worries me more than anything. Not just the direct economic hit, but all that uncertainty.
I heard some economists talking today, and of course the market fell, but some were wondering why it didn't even fall further than it did. And some are thinking that this is just so aggressive that people don't think that it could last very long. What's your take on that? Because really, it's hard to say.
Yeah, I think that's the right framing, is that it's hard to say. First, the market has already dropped significantly because a lot of the tariff turmoil was already priced in. The second is the president doesn't have to run for re-election again. So he might not be as concerned about what the stock market is doing if he thinks he's acting in the long term. Now, I think he's mistaken in that long-term play, but I don't think people should be comfortable in assuming this is all going away next week or even next month.
Scott, great to have you with us. Uncertainty is kind of the word of the day.